December 2025. The silver market is unraveling faster than anyone predicted. At 10:52 a.m. Eastern, the spot price flashes $6,700 per ounce. But when buyers rush online, the screens tell a terrifying story. Sold out. Every major dealer is either offline or rationing supply. Premiums have exploded $10 to $15 above spot, and it's not greed, it's scarcity. Industrial demand has devoured the global stockpile. Solar panels, electric vehicles, and AI servers have consumed 820 million ounces this year alone, far outpacing what miners could produce. The warehouses in London, New York, and Shanghai are reaching critical lows. The silver that once flowed freely is disappearing, and nobody knows when it will return. Dealers are trapped. Those who sold yesterday at $65 now face replacement costs of $72. Some dump silver below spot, desperate for cash. Others hoard, unable to deliver without massive losses. The market is fractured, a high-stakes chess game between survival and profit. For investors, the signals are clear. The spot price is a fiction. The real price, the price that reflects physical scarcity, is climbing fast. If the current pace continues, silver could hit $80 within weeks, possibly even higher before the year ends. This isn't just a market correction. This is a global supply crisis, a structural mismatch between demand and production, and the early stages of a physical silver squeeze that could redefine wealth, power, and strategy in the global economy. Stay alert, stay informed, because the next weeks will decide who wins, who loses, and who gets left behind. December 2025. The spot price of silver reads $67 per ounce, but if you try to buy physical metal, reality hits like a thunderclap. Sold out. Every major online dealer, JM Bullion, APMEX, SD Bullion, shows empty shelves. Premiums, once modest, now surge $10 to $15 above spot, turning routine purchases into urgent high-stakes decisions. This is not greed, this is scarcity. Dealers aren't inflating prices to manipulate buyers. They are responding to a brutal market reality. The physical silver simply does not exist in sufficient quantity. Those who attempt to sell risk paying replacement costs far above the promised price. Imagine selling 1,000 ounces at $67 and discovering your wholesaler demands $72 to replace it. Losses pile up in minutes. That is the invisible hand driving premiums skyward. Industrial demand is relentless. Solar panel manufacturers need silver for photovoltaic cells. Electric vehicle factories integrate silver into motors, charging systems, and connectors. AI data centers consume silver in circuit boards and thermal management systems. 820 million ounces vanish into these technologies this year, a number that dwarfs global mine production of 830 million ounces. There is no room for excess. Every ounce counts. Retail investors amplify the pressure. The silver stackers, long-term collectors, and speculators see all-time highs and rush to secure metal. Phones buzz, websites crash, Reddit threads explode, dealers freeze, hoarding inventory to survive. Premiums soar, not because someone wants more profit, but because there is no silver left to sell. The psychology of scarcity fuels panic. Humans respond to the fear of missing out more than the abstract notion of value. In markets, scarcity becomes reality before fundamentals catch up. When physical silver trades $10 to $15 above paper spot, it signals a deep market disconnect and a divergence between paper contracts and physical reality. Experts like Dr. James Turk, precious metals analyst, confirm this is a structural shift. The premiums are the market screaming that supply has collapsed. As premiums spike, smaller dealers are squeezed out. Only the well-capitalized, agile players can survive. Arbitrage opportunities evaporate because there is no supply to move. The gap between paper and physical silver widens with every passing hour. And every day the market remains in this state. The closer silver moves to a psychological threshold, $80 per ounce. The lesson is clear. This is a premium surge caused by real physical scarcity, not market manipulation. The signal is unmistakable. If you want silver, you pay the premium, or risk being left empty-handed. The countdown is on, and the market waits for no one. The silver market isn't just driven by investors. Far from it. The real story is industrial consumption. A quiet, relentless force devouring metal at a pace the world can barely keep up with. In 2025, industrial demand alone consumed 820 million ounces of silver, nearly equal to global mine production of 830 million ounces. The gap between supply and demand is not theoretical, it's tangible. It's visible in empty dealer shelves, soaring premiums, and the panic rippling through the market. Solar panels are the first voracious consumer. Each photovoltaic cell contains silver to conduct electricity efficiently. By 2025, solar installations worldwide required over 210 million ounces of silver, up from just 59 million in 2015. China alone is building solar farms the size of small countries. subsidized by massive domestic programs. The United States Inflation Reduction Act fuels a surge in rooftop and commercial installations. Europe races to energy independence. Each panel pulled from a warehouse, shipped to a roof, removes silver from circulation forever. There's no recycling loop large enough to meet this demand. Then comes electric vehicles, a technology that consumes silver at a pace few understand. Each EV uses 2 to 3 times more silver than a traditional combustion engine. Motors, battery connectors, and charging systems all rely on it. Tesla, BYD, Volkswagen, General Motors, millions of EVs roll off assembly lines, each vehicle swallowing ounces of silver that will never return to the market. In 2025 alone, EVs consume 90 million ounces, and that figure is set to explode by 2030. Artificial intelligence is the silent, hidden consumer. Massive data centers powering AI require servers embedded with silver in high-frequency connectors and thermal management systems. Microsoft, Google, Amazon, and Meta race to build facilities, quietly siphoning millions of ounces. This demand is largely invisible in official statistics because it's categorized under general electronics. But insiders know the truth. Silver is vanishing into circuits, never to return. Even traditional industrial uses, medical equipment, electronics, and industrial machinery, continue to draw silver, adding another 150 million ounces. Jewelry, silverware, and photography still account for hundreds of millions more. The math is brutal. Global supply, including mined and recycled silver, barely scratches 1.01 billion ounces. Demand exceeds that by nearly 190 million ounces, and inventories that once absorbed deficits are drained to critical lows. This is a market under siege. The industrial engines of modern civilization, solar, EVs, AI, aren't waiting for prices to stabilize. They consume, and they consume fast. Dealers freeze, premiums surge, paper contracts diverge from physical reality. Every ounce consumed industrially tightens the noose on supply, and the countdown toward $80 silver accelerates. Imagine walking into your favorite coin shop, hoping to buy a single silver eagle. You check the spot price, $67 per ounce, but the shelves are empty. Online dealers flash sold out. Premiums over spot are an $10 or two. They 10 to 15 higher. It's not speculation, it's scarcity. The metal has vanished. Dealers aren't greedy, they're trapped. This is the anatomy of a panic. Physical silver is finite, and replacement is instantaneous only in theory. Yesterday, a dealer sold 10,000 ounces at $65. Today, the spot price is $67, but the replacement cost? $72. $7 per ounce lost, multiplied by thousands of ounces. Tens of thousands of dollars evaporating in hours. This is the brutal reality of replacement cost risk. Small dealers, thinly capitalized online shops, even local coin stores, all are frozen in place. Some have stopped taking orders entirely. Websites show empty carts, red, sold-out banners, no phone responses. This isn't temporary. It's a strategic freeze, a survival tactic. Selling now means certain losses. Waiting may save them, but premiums rise as supply disappears, creating a vicious cycle. Less silver online pushes buyers toward fewer sources, inflating the price further. Other dealers act out of desperation. They dump silver below spot. Why? Margin calls. Loans taken at 50 per ounce suddenly become impossible to service when spot jumps to 67. Cash becomes survival, not profit. One day, they sell at $65 while competitors charge $78. The spread between lowest and highest prices, $13 per ounce, is unprecedented. Arbitrage normally fixes this, but there's no supply to move. The market dislocates. Even wholesalers and refiners are frozen. The Perth Mint in Australia and the Royal Canadian Mint are limiting production. The U.S. Mint is rationing silver eagles. Lease rates, the interest to borrow silver, have jumped from near 0 to 8% annualized, signaling a historic tightening. Those who hold silver aren't lending it, they're hoarding it. The consequence? Physical silver and paper prices diverge. Spot prices reflect promises. Physical markets reveal reality. Dealers trapped in this squeeze cannot restock without massive losses. Some will survive, most will not. The weak are shaken out. The only price left is the panic price. Every sold-out banner, every sky-high premium, every frozen phone line tells the same story. The market is fractured and the endgame is approaching. For investors watching carefully, understanding this dynamic is the difference between opportunity and catastrophe. The silver crisis isn't just about hoarders or dealers. It's industrial, structural, unstoppable. Every ounce mined is spoken for, sometimes before it even leaves the ground. 820 million ounces of silver vanished this year, swallowed by solar panels, electric vehicles, AI servers, and industrial technology. That's almost double the global mine production of 830 million ounces. The math is staggering. Demand is devouring supply, and there's no pause button. Start with solar energy. In 2015, the world used 59 million ounces of silver in photovoltaic cells. By 2024, that number exploded to 197 million ounces. In 2025 alone, estimates place it over 210 million ounces. Why? Solar isn't a niche anymore. It's national energy security. China is building solar farms the size of small countries. The U.S. Inflation Reduction Act subsidizes installations at a record pace. Europe is racing to energy independence. Every panel requires silver to conduct electricity efficiently. No substitute exists. Once silver is embedded in a solar panel, it's gone. Permanent, unyielding consumption. Electric vehicles are the second giant. In 2020, EVs consumed roughly 30 million ounces of silver. By 2025, that figure surged to 90 million ounces, with projections of 150 million ounces by 2030. Tesla, BYD, Volkswagen, and General Motors are driving this trend. Every battery contact, charging system, and electric motor relies on silver's superior conductivity. The world is transitioning from combustion engines to electric. Silver is the lifeblood of this revolution. Then comes AI and high-performance computing. Data centers powering ChatGPT, Google Cloud, Microsoft Azure, and Amazon Web Services are silent silver guzzlers. Servers need thermal management, high-frequency connectors, and circuit boards, all embedded with silver. Even conservative estimates suggest 250 million ounces of silver are being consumed annually in electronics and AI infrastructure. Other sectors, medical devices, industrial machinery, jewelry, photography, add another 350 million ounces combined. The total, 1.2 billion ounces demanded in 2025 versus just 1.01 billion ounces supplied, 830 mined plus 180 recycled. The result? A structural deficit of 190 million ounces, clawed from inventories in vaults from London to Shanghai to New York. This is the engine driving premiums, sold-out dealers, and panicked markets. Industrial demand isn't speculative. It's inelastic, permanent, unstoppable. Once silver enters a solar farm in Inner Mongolia, an EV battery in Nevada, or an AI server in Silicon Valley, it disappears from circulation forever. The physical reality is harsh. Production cannot keep up, and hoarding or trading paper silver cannot satisfy this demand. The stage is set. Every ounce consumed by industry tightens the squeeze. Every sold-out banner online isn't panic. It's the echo of real-world industrial hunger. Silver is being devoured, and the market is racing to catch up. The silver story isn't just about rising prices or soaring demand. It's about what's left behind, or rather, what isn't left behind. The world's silver vaults, once reservoirs of stability, are now bleeding metal at an unprecedented pace. Every ounce that industrial giants, investors, and sovereign buyers consume is gone forever, and the inventories that once bridged the gap between supply and demand are evaporating before our eyes. Consider the numbers. The COMEX registered inventory, the metal actually available to settle futures contracts, has plunged from over 150 million ounces in 2018 to less than 40 million ounces in 2025. In the first 4 days of December alone, it dropped another 60%, leaving fewer than 16 million ounces, barely enough to cover 2 weeks of global industrial demand. That's not a minor drawdown. It's a crisis unfolding in real time. London tells a similar story. The LBMA vaults, the heart of the physical silver market for decades, are now at levels unseen since the 1970s. Leaks from insiders suggest that physical silver available for delivery has been siphoned off by industrial buyers and nation-states, particularly China, which is rapidly absorbing metal to feed its solar, EV, and tech industries. What lands in Shanghai never returns. It's immediately consumed and embedded in products, vanishing from the global supply forever. Even the U.S. Mint and Royal Canadian Mint have struggled. Silver Eagles, Maple Leaves, and other bullion coins are rationed or sold out entirely. Dealers across North America report frozen inventory, a phenomenon not driven by greed or speculation, but by sheer physical scarcity. Shops refuse to buy, online giants go dark, and replacement cost risk traps wholesalers in a web of uncertainty. This depletion isn't a seasonal blip, it's structural. Governments, banks, and industrial vaults are all drawing down stocks to satisfy demand. The reserves that once buffered spikes, the hidden insurance of the silver market, no longer exist. Once these stocks are gone, there's nothing left to stabilize prices. The psychological effect is equally devastating. Traders watching premiums surge $10 or $15 above spot understand that the paper price no longer reflects reality. When the physical metal disappears, panic and opportunity collide, creating explosive volatility. Dealers who do have stock can charge exorbitant premiums. Those who don't are sidelined, waiting for relief that may never come. In short, the silver market is no longer liquid, no longer predictable. Vaults are emptying, inventories are collapsing, and every industrial ounce consumed accelerates the squeeze. This is the mechanism behind sold-out banners, skyrocketing premiums, and the panic rippling through global dealers. The real question now, what happens when the last of these vaults are tapped? The answer is coming sooner than most think, and it will define the next phase of the silver squeeze. The silver crisis of 2025 is only the beginning. While inventories are collapsing and premiums are surging today, 2026 threatens an even deeper shortage. Analysts at the Silver Institute project a global deficit of 215 million ounces next year. A number so staggering, it redefines the very rules of supply and demand. Why is this happening? Start with production. Global silver mine output has plateaued at roughly 830 million ounces per year. For years, exploration budgets were slashed because silver prices were low, hovering in the teens. Mines that could expand are already operating at full capacity. There is no tap of extra supply waiting in the wings. Even a $67 silver price cannot magically create more metal. Mining new sources takes 7 to 10 years from discovery to production, a timeline that investors and industrial buyers can afford to wait for. Meanwhile, demand is structural, relentless, and accelerating. Solar panels alone consume over 210 million ounces in 2025, and installations are projected to double by 2030. Electric vehicles are using more silver per unit than ever, 90 million ounces in 2025, with projections exceeding 150 million by 2030. AI-driven data centers, medical devices, and industrial electronics add another 400 plus million ounces annually. Unlike gold or oil, silver in these products never returns to the market. Every solar panel, every EV, every server permanently removes metal from circulation. Now combine flat production with skyrocketing consumption. The math is simple but terrifying. Supply cannot keep up. The gap widens. The registered inventories that once acted as buffers have been drained, leaving the market exposed. 2 weeks of industrial demand is all that remains in COMEX deliverable silver. 2 weeks before the next surge consumes every ounce. This is why premiums of $10, $15 and above spot are no longer anomalies. They are the market signaling real scarcity. Dealers, miners, and refiners are caught in a trap. Sell too fast, and replacement costs explode. Sit tight, and premiums rise even higher. The stress is compounding across global vaults, from New York to London to Shanghai. And here's the kicker. Geopolitical forces are accelerating the shortage. China's industrial expansion is absorbing massive quantities of silver, never to return to Western vaults. European energy independence programs, U.S. solar incentives, and global EV mandates are all pulling more silver into permanent use. The deficit isn't temporary, it's structural. In essence, the silver market is entering a new era, a physical squeeze that will test dealers, investors, and governments alike. The 2026 shortfall of 215 million ounces is not a distant threat. It is imminent, it is unavoidable, and it will dictate prices, premiums, and market behavior for years to come. The question hanging over the market: who will survive the next wave? And who will be left holding promises they cannot fulfill? The silver squeeze is real. The dealers are trapped. Supply is vanishing. Premiums are soaring, and the deficit is only getting worse. Right now, every ounce counts. Every decision matters. Will you be prepared or left behind? If you are a long-term investor, now is the time to stack wisely. Understand the difference between paper silver and physical silver. Watch the miners that are poised to explode in value as the deficit deepens. If you are a trader, patience is your weapon. Wait for consolidation. Watch the price levels, $65 or $70, $75. These are not just numbers. They are battle lines in a market in chaos. This is more than a market movement. This is history in motion. The patterns you see today will shape the next decade of wealth, power, and global economics. Do not ignore it. Do not wait for confirmation. Knowledge is your edge. Awareness is your armor. Subscribe now and never miss the secrets shaping our future. Hit the bell, stay informed, stay sharp, and welcome to the Silver Squeeze.